The global guessing game over Europe's bailout plan continued overnight when a report surfaced that France and Germany will boost the continent's rescue fund to nearly $3 trillion. That was later scotched by EU officials, but it was enough to excite investors on Wall Street, where the S&P 500 rose 2%. But the latest rumour came after the close of trade in Europe itself, where markets were mixed. While the world waits for political leaders to come up with a solution, the concerns about Europe's financial system are once again pushing up the cost of bank funding. Here's a graph presented by one of the Reserve Bank's assistant governors, Guy Debelle. The blue line shows the cost to European banks of borrowing from each other, which in recent months has been going up sharply, although it's still nowhere near its peak of late 2008. By contrast, the red line shows funding pressures on Australian banks have been easing lately, which is why some of them have been cutting interest rates on business loans and fixed-rate mortgages. On the local market today, Australian stocks made some solid gains, but the All Ordinaries again failed to break the 4,300 barrier. Banks and insurers led the way, while CSL rose 1% after announcing a $900 million share buyback and affirming its profit guidance. BHP Billiton edged higher after a solid September production report, although other mining stocks were weaker. And the Australian dollar is moving higher against the major currencies. The main piece of economic news today is the Westpac Melbourne Institute Leading Index, which tries to predict the level of activity in the next 3 to 9 months. It rose nearly 1% in August and now sits above its long-term average, suggesting a rebound in growth could be imminent. But try telling that to jittery investors. And that's finance.